Good afternoon. This is Tom Alexander. It is Saturday, January 7th. It is about 3:06 p.m. Eastern Time in beautiful Charleston, South Carolina, and a lot to discuss as usual. We're coming out of a very, very interesting and vexing, really almost 3-week period in the stock indices where we had head fakes up and down. We had one of the most protracted balance areas over both duration and range that I can recall seeing in the stock indices. And it appears now that we have an initiative break to the upside. So let's take a look at the charts and dive in a little bit deeper and see what that might portend heading into next week. Now, by the way, this is the weekly video addendum to the written report that all of you have received. If you have not received this and you would like to receive it, please send me an email, tom@alexandertrading.com. I will put you on the list and you will receive the free written reports that I send out occasionally and certainly at least once a week. Also, if you find value in this, it would be of tremendous help to me if you will subscribe, if you will like it, and if you will comment on it. And comments can be anything you choose, and I'm certainly more than willing and happy to answer any questions you may have. So, what you see on the screen here, the four primary U.S. trading indices, the cash markets, the S&P, the SPX, the NDX, the Dow, and then the Russell in the bottom right corner. And we had this excruciatingly whippy day-to-day trading range again that lasted almost 3 weeks. Now I'm going to point something out, and this was very minor, but it accompanies almost every significant pivot turn on a daily basis in the stock market. There was once again a little divergence. This was a little more subtle than some of them are, but you can see the cash market in the NDX here. On Friday, we dipped below Thursday's low very briefly. The other indices did not. And we were looking at this in real time in the live trade room. And it's if you go to a shorter term chart down to say a 5-minute chart in the futures contract or even the cash market contract for that matter, it's quite clear. And those are important things to watch, especially if you're a very short term trader. Okay, so what do we have here? Well, this is a very specific auction market condition. You know, there are times where you're not real sure what the market is doing. And then there are times where you can be very sure what the market is doing based on certain well-founded assumptions. There are two market phases in auction market trading and slash market profile trading. And understand the market profile graph is just a visual artifact of the auction process. Nothing more, nothing less. It is a graphing format. The magic is in understanding how auction markets work. Auction markets follow the same path of development all the time, in all time frames, and all assets. And what we have here is a live case study in what follows an extended balance area. When you are in an extended balance area, and in a balance area, if you market profile, aficionados can visualize that Gaussian shape that everybody thinks of that pops into their head when you say market profile, you see this Gaussian shape. Well, what that Gaussian shape represents is a mature structure. It's a mature market. And what follows that is a trend, almost always. That's sort of auction market profile, trading tenet 101. So what we have now is an attempt to break initially to the upside out of these markets. Certainly, Friday was an extremely robust day, both from a range perspective as well as an internal perspective, which we'll get into in just a minute. And you can see 3 of the 4 indices have exceeded the upper extreme to their balance areas. You can make a case the Russell has a little bit more to go to do that, but everything else is pointing to higher prices. Now, everything is pointing to higher prices again under an assumption, a very specific assumption, and that is that we're in the very early stages of an initiative break to the upside. What should not happen at this point, especially early next week, is a retracement into the 50% levels of the respective indices. If all four of the indices were to retrace to the 50% retracement levels, it's a heads up. Okay, is something else going on here? And if we were to close below the 50% retracement levels, it is a bearish signal. Now, do I expect that to happen? I don't really expect it to happen, but as you see in this market, and I have been wrong several times directionally because we have been head faked by price action as well as internals in this for the past 3 weeks. So, but I do know that that is the important level now to the downside is the 50% retracement level of the respective indices. That level is important. And really what you should see, ideally, you should see further strength on Monday, if not a gap up in Globex for further strength. How high can this go? Remains to be seen. But this was a very mature structure. It lasted a long time, and there's a rough correlation between how long these balance areas last and the ensuing sharp move. But if the market does indeed trade higher next week, we will continue to monitor and we will continue to get clues about the strength of the rally and if the rally is behaving as it should be. If we're going considerably higher, similar to say some of the more robust rallies that we've had in the bear market. So there's a lot of this is an important rally. If it can generate some legs here to the upside, this is a very important rally, and it has the potential to surprise people. Okay, so let's take a look now. And by the way, I put in the written report, I put the profile view of the S&P because it gave, well, let me just say, I might have it right here. It really shows a classic balance area and subsequent inevitable initial break. Here we go. Here it is. So this goes back to, this is the 1219 to 15 profile view. This is all the trade that occurred from 119 into Thursday. This is Friday's trade. And you can see in Globex, that's the colored letters, the blue and the green. In Globex, we traded below the high volume node and then promptly ripped higher in the cash session. And now we're closing at or above the upper extreme. We're closing above the upper extreme, as you can see on the bar charts. But this is that classic Gaussian shape of a market profile. It's a classic, extended mature auction. It has a very, very pronounced high volume node area of greatest value, so to speak. So this is what it looks like. This is what you're looking for, and this is what you're looking for regards to the time frame you trade. I can show you the same thing on a 5-minute chart. You have these minor balance areas, and then you have breaks from those balance areas. But this just shows the robustness of this because of the fact that an auction market follows the same path of development, same stages, same path, in all degrees of time, all the time. Okay, I digress a bit. Apologies. Let's take a look now at a couple of other things that I think are important immediately that we watch, that we want to be watching. And I'm going to go to breadth first. Okay, I put this in the report pretty much every week. This is something I've used for most of my 38-year trading career. It's sort of a blunt instrument. It's contextual. It requires interpretation, etc. Those are all the qualifications. This is cannot be rote traded. Now, what should happen, what happened on Friday is we had the biggest expansion of breadth that we've had since November 10th. Now, this expansion in breadth was not as great as November 10th, which is sort of interesting, but it would not be unusual to see another really strong breadth day in the next day or two, especially if this is what we think it is, which is an initiative break to the upside. There is room for both the 10-day and the 5-day moving averages to reach an upper extreme prior to even beginning to look for any sort of top, because typically when those reach an extreme, like for instance, back here in July, we went up for another couple of weeks and went considerably higher before we topped out. So that would, and you had the same thing here. So there's plenty of room. The information here is there is plenty of room to go to the upside. Now, one thing that I've been talking about for weeks is the fact that we have one negative 2000 breadth reading since the bottom, very near the bottom back in October. And it has been unusual that we have retraced this far off of this high without generating that level. But you know, I always say, always default to price, always default to price structure and price behavior. Price behavior, price structure suggesting the benefit of the doubt has to go to the upside. Has to go to the upside as long as the 50% retracement levels of the Friday's ranges in the cash market holds. Okay. Now let's take a look at a more granular view of breadth. And this is a 30-minute bar chart of the S&P futures cash session. All right. And if we go back to this top, which was the end of November, we have 1, 2, 3, 4, 5 instances when breadth expanded to levels very close to what we saw on Friday. And in every single one of those previous 5 cases, there was almost an immediate top and a decline. Now, the declines were very sharp heading into this latest balance area. But in this balance area, the tops of the balance area rallies, the rallies to the top of the balance area, were coincident, were also accompanied, that's what I'm trying to say, accompanied by this expansion in breadth. Well, we have another expansion in breadth as it appears price is attempting to trade initiatively yet again. So what we don't want to see now, and this is why it's important to see further price strength next week with very little retracement into Friday's range. Otherwise, if we start retracing deeply into Friday's range, is it another top? Could well be. That's what this would be saying. Now let's take a look at a situation back in June, July, when we had that ripping rally into the August top. This was the initial kickoff move off this low. And then you can see within 2 days, we had an even higher momentum peak in breadth. And then you had the market continued to trade higher, and the retracements in price were accompanied by breadth readings that seldom got below 1,000. And if they did, they were not below 1,000 for very long or by very much. And the market would trade higher. And then what happened, what ultimately signaled this rally was over, was the first day, and this was intraday, that we saw a negative 2,000 breadth reading. So that gives us something to keep an eye on next week. If we start retracing deeply into Friday's ranges, we have breadth that's negative 2,000. Even if it's intraday, that's a real heads up. That would be a signal that maybe this isn't as bullish as Friday made it appear to be, and the fact that we should be moving very, very sharply now out of this balance area, and it actually should go considerably higher. Now, here's something else. If this were to fail, the ensuing move to the downside would be extremely sharp, extremely sharp. So keep that in mind. I'm not predicting what's going to happen. What I think is going to happen is we're going to continue higher. But as I always like to say, it's fine to have an opinion, it's fine to have a narrative, but you have to know what invalidates it. And in this case, I laid out both from a structural price action perspective as well as a technical perspective, what should not happen under a bullish scenario. So guys, I hope you found this useful. Again, please like the video, subscribe. If you are not receiving the written report and you would like to receive it, send me an email at tom@alexandertrading.com. Enjoy the rest of your weekend.